If a life insurance policy no longer fits your needs or your budget, there may be another option besides surrendering it to the life insurance company for its cash value. It's called a life settlement, and it's worth understanding before you decide. At a basic level, life settlements are usually considered for people age 70 or older who own a policy with a face value of $100,000 or more. Health is another important part of the picture. The best candidates have had a minor or moderate decline in health since they first bought the policy. That may sound surprising, but from a buyer's perspective, a shorter projected life expectancy can make the policy more attractive as an investment. Policy type matters. Universal life policies are often the best fit because premiums are flexible and can be adjusted, making them easier for institutional buyers to maintain. By contrast, a term policy that cannot be converted usually does not receive offers because buyers convert term policies into some form of permanent coverage that can remain in force long enough to have investment value. But this would require a medical exam, and the premium would be set based on the person's current health, which may prove too high for the math to work out. If the person is in very poor health, the insurance company will decline the conversion attempt altogether. For some families, the question is not whether the policy has value. It's whether that value could be more useful now than later. A life settlement may help support retirement income, pay for unexpected medical bills, or contribute to the rising cost of long-term care. Often, the real pressure comes from premiums that have risen dramatically, sometimes to a level too high to maintain. That can happen with certain universal life policies, where keeping the coverage in force becomes less realistic as the years go by. In that situation, a life settlement may be one alternative to explore before deciding to surrender the policy back to the insurance company. The right answer depends on your goals, your health, your policy, and how much value the market is willing to offer. Here's an important awareness gap. Far more life insurance policies are surrendered than ever make it to the secondary market for review. That doesn't mean every surrendered policy would qualify for a life settlement. It does suggest that many people may be making decisions without first seeing every option. When a policy becomes too expensive to maintain or is no longer necessary, people often assume surrender is the only practical option, even when another path may exist. Many families never hear about the life settlement option. That's why education matters so much here. Before walking away from a policy, it's worth finding out whether the market sees value that you haven't yet been shown. When you surrender a policy, the insurance company will pay you an amount based on the current net surrender value. That's not a market test. It's one amount versus a bidding process. A life settlement works differently because the policy can be reviewed by multiple institutional buyers who may compete to purchase it. That competition can matter. In some cases, the secondary market may uncover more value than the surrender amount offered by the insurer. Not every policy will bring a strong offer, but comparing options can give you a fuller picture before you make a final decision. These decisions rarely affect just one person. Adult children often help parents with retirement income, caregiving, and sometimes paying for long-term care. That can bring real financial strain, but also emotional strain, especially when a family is trying to balance dignity, independence, and practical costs all at once. A life settlement is not the answer for everyone, but it may be a strategy worth evaluating if a policy is no longer needed or affordable. Sometimes the most helpful step is simply learning what the policy might be worth so the whole family can make a more informed decision. If you decide to explore a life settlement, who you choose to represent you can make a meaningful difference in the outcome. Some direct-to-consumer television advertisers actually represent institutional buyers, whose fiduciary responsibility is to their shareholders. So, those buyers are naturally looking to purchase a policy at the lowest possible price. On the other hand, a fiduciary life settlement company works on your side and can present the case to multiple institutional investors rather than relying on a single buyer's offer. That bidding process is designed to seek the highest possible value the market may support for your policy. As many as 10 to 40 bids can be secured, with institutional buyers competing against each other. If you'd like to see whether your situation and policy may qualify, click the link in the description below and complete the short assessment. It's free, it takes less than 2 minutes, and you'll get the results immediately. It's a simple next step that can help you understand your options with more clarity before making any decision.